can you explain the difference between long-term capital gains and short-term capital gains and what the tax implications look like? Because I feel like a lot of people don't know that you will get heavily taxed when you sell a stock and yeah.
Yeah. And there's actually some ways around that I'll explain. Very, very cool. Something that my firm and others have been doing in the past year. But capital gains, it just capital gains 101. You put $1,000 into a stock, it grows by $50. You're taxed on that $50. That capital gains tax. It's pretty much exactly as it sounds. So let's say I invest $100 today. It's March, and I sell it in April, right?
Mm.
That's less than a year holding on to that asset. So I would pay something called short-term capital gains tax. That just means you held the asset for less than a year, you're going to pay a little bit higher tax on those capital gains, and that's based off your ordinary income. So it's not like a single number. Um, if I were to buy the stock today, March of 2026, and sold it in April of 2027, then I would pay something called long-term capital gains tax, which is lower because I held it for a year. So that's basically the ins and outs of what, long and short-term capital gains tax is. But something that firms have been doing recently is something called direct indexing. So that is where take the S&P 500 for example. The S&P 500 has 500 stocks in it, right? But they all move like this as one. They all move together. Direct indexing is buying all 500 individual stocks of the S&P 500. For example, it's any fund. This last year, 300 of the stocks in the S&P 500 were in the green. They went up. The other 200 were in the red. So they actually lost value, but you only see the return in the green because they take the entire thing as a whole. What direct indexing does is buys each individual stock, and at the end of the year, you sell the losers. I'll say that again. So at the end of the year of your 500 stocks, the 200 that were losers, you sell those. And like there's capital gains, there's also capital losses, but you don't pay taxes on those.
Hmm.
So what you can do, sell the losers, hold on to the winners, the capital losses go onto your 1099, and that rolls over to the next year. So it looks like you have a negative $20,000 loss on your stock portfolio, so they won't tax you on it. Let's say the same thing happens. This time, 400 of the stocks are up, 100 of them are down. You sell the losers. Pretty soon, you have $200,000 in capital losses. And by the time you're ready to take out $100,000, they just offset each other. So you pay zero tax.
Wow. Yeah, and yeah, that's just like hedging the bet, I guess. It's just you're losing and
Yeah.
you're winning and it just zeroes out. That's awesome. So and then yeah, I guess just throwing on your 1099. That's pretty cool. Wait, so for
Yep. And then
explain the 1099 to people who don't know what 1099 is as well, because you just said throw it on your
so that's just a
1099.
cap. Yeah, so that's just you get that every year for your investment account. That just tells you what you owe on your gains that you sell. Uh, so it's just part of your tax return. Like that's something you just do when you file your taxes. But um, so some people might be thinking like, why would we sell these losers if we're losing $200,000? Well, you got to remember we're buying the individual stocks and selling the losers, but we're holding on to the winners, right? So we're still getting the same exact return. We're just breaking it down into 500 different pieces.
Yep.
So that's something that firms have been doing to help people not pay capital gains tax. Obviously, it's very situational. Like you need to, you probably need to be a high income earner,
Sure.
need to have a lot of money in an account. But the point in saying that after my quick lecture there is that there are definitely things that you can do to create the best financial situation for yourself. That's why it's so important to do your research. It's so important to look into all your options, working with firms. There's a lot of not general knowledge stuff out there that's super, super interesting. I remember being taught this direct indexing thing and just thinking, holy shit. Like
All right.
it's pretty cool. The ways that you can manage a portfolio to create such a big return and then mitigate as much taxes as possible. It's really cool.
Yeah, I mean, that's And I guess in short, that's what the rich do is find ways to make taxes work for them in a way.